Welcome to TheoTrade. This is Don Kaufman. Here we are. It's June 10th, 2017, doing the weekend update. Well, finally, we have a bit to talk about in this previous week of trade. So this weekend update over here, we have a lot to go over. Not only of what we saw, some of the activity, of course, not just yesterday, but even previous to that, but more importantly, being forward-looking. We've also got some big-time announcements to make, so stay tuned towards the end of this video for some big-time TheoTrade announcements over here. So let me start with the sell-side activity, of course, that we saw in the Nasdaq, and really what we can expect kind of moving forward. And I think, again, everybody, you caught a little off guard by some of the sell-side activity. So I've pulled up the Nasdaq futures. So for those of you that maybe were unaware, you just saw the close over here, what ultimately occurred inside of the Nasdaq, and is this likely to be an isolated issue? First and foremost, what really sparked the sell side activity in the Nasdaq? Well, people are pointing a finger towards a memo that came out from Goldman Sachs. And what did the memo say? It ultimately said, well, we have stocks like, let's start with Microsoft over here, all right, Apple, Google, okay, Amazon. They're pointing fingers and saying that these underlyings, all right, are overbought and heavily weighted, and that these underlyings alone, accounted for over 50% of the gains of not only the Nasdaq, but specifically the S&P 500. Now, and that, by the way, that's year-to-date gains in the S&P 500. All right, so Goldman Sachs comes out with a note, and the Nasdaq futures go completely and utterly nuts. Now, first and foremost, this is a news flash over here. This is not news. I mean, everybody realizes that these products, okay, and specifically, your Facebook, your Apple, your Googles, your Amazons, and Microsoft over here, you want to throw Tesla in the bunch, go for it. All right, they've clearly been overbought, but overbought is so cliche in this marketplace. Things have been overbought for 2 to 3 years in certain aspects of it. Okay, looking at the sell side activity, things got a little bit out of control. And again, the reason I brought up the Nasdaq futures, a few things I want to show you. First and foremost, the Nasdaq futures on a day-to-day basis, these things are lucky to trade 1,000 contracts per minute. This is a 1 day, 1 minute. And if you zoom in very tightly over here, I'm just going all the way for it. Yeah, we did a minute in here that was north of 7,000 contracts. And this doesn't look like that much, but I just want to point out that 1 minute saw a 33-point move in the Nasdaq futures, 33-point move in the Nasdaq futures. In an average day lately, we've been lucky to see 20 points of movement in the entire trading day, okay? But we get 30 points of movement inside of a 1 minute candle. Now, zoom out for that for just a second. What stopped the market from selling off into Never Never Land, and what stopped the market from selling off into an oblivion? And more importantly, what we actually saw on Friday was a flush of very specifically, okay, a handful of the big market cap stocks. In fact, we even created our own little index here at TheoTrade. And we did this in a video just about a week ago. Many of you actually tuned into it, where we actually took Facebook and Apple and Microsoft and Google and Amazon and added them all together, and we weighted it. And of course, you can see these underlyings getting pummeled over here. However, if you look at this from the perspective of, all right, Don, I get it, but it was only isolated to the Nasdaq. Okay, let's talk about isolation and the premise of isolation. So the Nasdaq gets absolutely pummeled. At the time that the Nasdaq is getting pummeled, out of seemingly nowhere, it bounces and recovers. And I want to go very specifically into this time frame over here of the recovery in the Nasdaq, because frankly speaking, the recovery in the Nasdaq had absolutely nothing to do with the Nasdaq and everything to do with the S&Ps, and allow me to show you. So the huge and just precipitous kind of wild sell-off occurred at 11:49 Pacific time. It was all hands on deck. Everybody was firing sell-side activity. Every algorithm was lit up. There were actually little signs of what we kind of call flash crashes inside of some of your major technology stocks. Okay, if you didn't see this before, It's worth taking a look specifically into like Amazon. There was a mini crash inside of Amazon that didn't really trigger any circuit breakers, nothing of the kind. And it all happened again between 11:49 and 11:50. And this was Pacific time. Again, that is a trade all the way down to 927. $927. Okay, the thing closed just shy of 1,000 over there. That's how serious it got. Now, what ultimately occurred, okay, and why the market stabilized, go back to the SPX. So on a week-to-week basis, I've been denoting a lot about expected moves, and I'm going to talk for a moment about expected moves. And if you're sick of that conversation, I'm going to tell you right now, the only reason the market did not completely and utterly implode on Friday was specific to the SPX. The SPX expected move for the week bounced the entire marketplace. Okay, everything is about gamma risk right now. Everything is about traders selling straddles and selling strangles and then hedging off the risk. And I want to show you exactly what this looks like over here. So I'm going to zoom out for just a moment. These are the expected moves now 15 weeks back. Okay, I've even got the expected move for the next and coming week. So for those of you kind of uninitiated, I'm going to give you a brief overview once again of expected move because I can't stress to you enough. This is what matters in the market. Then we're going to go back and we're going to explore the Nasdaq. Okay, when I explore the Nasdaq, everybody wants to know right now, is the sell side activity that we saw in the Nasdaq going to proliferate? And I'll discuss that here momentarily. But substantially more important at this point is your understanding, okay, of what really happened this past week. So we see the week started at 2439 on the SPX. Okay, the SPX is the single most important product. Why is the SPX so important out there? It's because the volume of trade is all being driven towards the SPX. There are hundreds of thousands of contracts, for example, in this next week's expiration. Now, a quick reminder in expected move. And by the way, I got a ton of questions and emails about expected move this week, and I want to address a couple of them right now after I show you why expected move saved the markets. So forward looking, the expected move this coming week is about $26. But let's be backward looking for a moment. Right? Look back to the previous week. And all right, where are we at today? Here we are on the 10th. To go back to the previous week, we'll jump back to the 3rd and we'll look at the full week. So the expiration was June 9th. The expected move is about $20.55 last week. Now, let's all be clear about expected move. Expected move is not a number that I derived. Expected move is not a number or a calculation that thinkorswim or TD Ameritrade derived. Expected move, okay, resonates throughout the entire financial industry. Okay. The other thing I want to mention about expected move is there's absolutely no directional bias to it. And there can't be any directional bias because expected move is derived specifically from the option prices themselves. Okay. So when it says plus or minus $20, do you know why that there's no directional bias to it? Because when traders come in, they'll sell both sides of the marketplace. Okay, it can't be weighted to one side or the other. There's no memory, okay, to expected move. This is not historical pricing. You have to realize what expected move really is. It's like taking a temperature of the marketplace 6 days out into the future. So if you really want to know, okay, what markets are anticipating, not being backward looking, what good is last week going to do me? And when I say that, all right, last week we had a $20 expected move. This week we got a $26 expected move. Want to see something even crazier? Go look at the Nasdaq. Inside of the QQQ, last week we had a $1.75 expected move. Okay? This coming week, we have almost a $4 expected move. Why? Because the proverbial crap hit the fan in terms of volatility inside of the Nasdaq. So there's absolutely no historical knowledge inside of expected move. It's all based on implied volatility, implied risk. And again, what really sets expected move? Okay, and that's what you have to get to the context of. And the meat of the equation, all right, is a very simple idea. There is no equation to expected move. Okay, there is no historical knowledge of expected move. It's only about option pricing, okay, for 2 days, option pricing for 4 days, and option pricing for 5 days out. Expected move is derived exclusively from the price of the options themselves. And that's why there's absolutely no directional bias, because option pricing doesn't tell you, oh, are we going up or are we going down? Yes, we are. And this next week, we're supposed to move by a rate of about $26. Now, back to last week. Okay, then I'll come back to more an expected move. I just thought it was important to recap a little of that. Back to expected move. The week starts here. When I say here, okay, this is last week, and I'm actually going to draw this specifically on your screen. Okay, so last week, expected move starts the week right here. And as I said, it's about plus 20 or minus 20. So we're skirting along the week, no problem. This is Monday, this is Tuesday, this is Wednesday, this is Thursday. All of a sudden, Friday hits. Friday hits, there's huge sell-side activity. We literally start the day right around where we started the week. Huge sell-side activity. We pierced right through the bottom of the expected move for a fleeting second and ripped right back up. What ultimately saved, okay, the Nasdaq from its demise was expected move on the week. Do you think, okay, this is just a line on a screen that the market decided to stop on? This is gamma risk. And what happens is right when we get through 2418, they have to come in and then turn around and buy the S&P futures back. So you sell S&P futures to the edge of the expected move, then your risk literally at this point in the edge of the expected move, okay, your risk right now forces you to sell S&P futures. When you crest through the expected move, you have to turn around, you have to buy S&P futures, because right here, X marks the spot. That's actually where your delta risk flips over as a professional trader. And all the professional trading firms care about, they're not directionally biased. They can't be directionally biased. Okay, right now, the way that Dodd-Frank sits, all right, and Dodd-Frank may change. I'll come to that in a moment. But right now, the way Dodd-Frank sits, they can't take directional bias. And there's no memory to it whatsoever. You just be forward looking. So I got a lot of emails about like, hey, you know, we could take historical volatility and we can try to figure out like expected move. And I'll give you a perfect example. You know, you can go into a product like Apple and you could look at historic volatility and maybe we can figure out how far Apple can move up versus down over there. Well, there's a number of major issues with that. First and foremost, okay, if you look at historic volatility, the volatility around the earnings, they're 300 to 400% greater. Meaning the historical volatility, which is the annualized standard deviation of the past stock price movement, right? The movement around earnings would influence that equation. It wouldn't work, okay? There can't be historical volatility. There can only be implied volatility in the expected move. That's an expected move. If you want historic volatility and you want something that works historically for expected move, just pull up Bollinger Bands. What do you think they are? Bollinger Bands are nothing more than what? They're volatility bands. They're same as Keltner channels, all very, very similar. But that's historical kind of movement. When you're looking at something like Apple, you want implications forward, because nothing historically, and this is the point I want to make, nothing historically in this chart is going to tell you when Goldman Sachs comes out with an announcement. And when Goldman Sachs comes out with an announcement and mentions Apple, Apple's expected move this coming week is $5.60 now. Okay, now you know that. Now, last week, okay, the entire week had a $3.28 expected move. So again, it's critical to denote that expected move is always going to be a forward-looking equation out there, and it's just based on the option premiums themselves. That's it. Okay, nothing more, nothing less, and there can be no directional kind of bias to it. Wanted to show Apple over here. It's one of my larger short positions right now, and hey, we're at least in the money on this one. Now, switching gears a little bit on you. So before I go back to expected move in the SPX and be forward looking, again, I want to show you that specific moment that we touched into the expected move. The specific moment that we touched down into the expected move. It's 11:49, okay? We printed 1150, and ultimately the firms had to turn around and they had to buy S&P futures. They turned around and bought Nasdaq futures as well. The market ultimately stopped cold. My entire conjecture for what's going on in the markets lately is incredible efficiency. And for those of you if you caught the session I did the other night, and there's a YouTube video out on it, but if you caught the session I did the other night, we found out that ultimately the SPX, okay, almost 85% of the time is staying inside the expected move, okay? And yes, the SPX stayed inside the expected move this past week. And for those of you also that tuned into that, okay, our tetrapod spread worked incredibly this past week because the SPX, where we sold the premium, stayed inside. The QQQ, okay, what did the Nasdaq do? It smoked the expected move. People were looking here, okay, two deviation move. So now we ultimately have, check this out, we have 1, 2, 3 weeks where the Nasdaq blew through the expected move, okay? And at the exact same time, the SPX ultimately mitigated its risk, stayed right into the inside of that expected move. Now, let's be a little bit more forward-looking over here, okay? So we got through a little bit of this, that, and the other. Be a little bit more forward-looking. One thing I want you guys to think about is the correlations that went on in the market. So what you're looking at here are the S&P 500 sectors. This is 7 sectors up, 4 sectors down, neither here nor there. All I want to show you is the only thing that got pummeled was pretty much IT the other day. Also, one of the craziest things I've seen in quite some time, if you go look at the S&P 100, do you know at the close of the day that there were actually 70 advancers in the S&P 100, 70 to 30. The advanced decline line was positive in the S&P. So immediately everybody's quick to jump to the notion that it's okay, we're all going to be all right. Okay, why? Well, we sold the Nasdaq, but we bought the financials. The financials, okay, were the predominant beneficiary. Now this scares me. Okay, why does it scare me? The financials, and I've talked about this, okay, ad nauseum, getting above 24 is critical because once the financials get above 24, it could fuel the S&Ps substantially higher. Of course, you'd have to have the Nasdaq in agreement with that. But I want you to think about this from a very, very different perspective because the last time I saw stuff like this going on, you know, sell the Nasdaq, buy the S&P, sell the Nasdaq, buy the Dow. It's very reminiscent of what happened in 99 and 2000. And in March of 2000, it took weeks, even months for this to unfold. What was going on in 99 and 2000 is the beginning of the sell side activity before the market fully crashed in 2000 is people were not buying anything but tech stocks. Then they turned around and sold tech and bought anything but tech and then turned around and just ultimately sold everything. But what scares me the most about this, and I want you to think about this logically, if you look at the XLF, okay, first and foremost, it was Goldman Sachs that came out with the note about, you know, the FANG stocks. So Goldman Sachs comes out with a note, and the best part of the entire story over here is look at Goldman Sachs stock, which traded up almost, you know, 1.7%. And you look at Goldman Sachs, and I'll cruise down the screen over here. Look at JP Morgan. The way that I view this is, okay, you literally are on a sinking ship if you're in the Nasdaq. You're on a sinking ship. That thing is sinking fast. And you got guys like what? Lloyd Blankfeld? What? Jamie Dimon? Maybe a little Vikram Pandit. If you don't know who these people are, it's the CEO, respectively, of what? Goldman Sachs. JP Morgan is Jamie Dimon, you know, Vikram Pandit out there, Citi. I could go on and on and on. Don't even get me started on Wells. Who knows who the CEO of that thing is? If you're on a sinking ship, do you take a life raft and do you hop in the life raft with Jamie Dimon? Because that would scare the hell out of me. I'm pretty sure a day or two into it, they're going to eat me. So I have to be, at this point, very, very pessimistic on this asset rotation because number one, it is reminiscent of what we've seen before. Okay, initially sell side activity starts to scare the crap out of everybody in one sector. So what do? They run to the other side of the boat until you realize the entire boat might be going down. And the craziest thing about this is, first of all, nobody wants to touch financials the other day until, of course, the Nasdaq is sinking. This is the best one. Okay, you couldn't find a buyer, right, for the XLE in what? The last couple of months. But the XLE, oh, this looks like the greatest thing on the street out there since, of course, everything else is diving. You need to be very, very careful in the week to come. Markets typically don't, okay, do this for very long. And what's this? They don't do the asset rotation game for very long. They don't go and rotate sectors for very long. Correlation coefficients during sell side activity often exceed 95%. What that basically means is, you know, in a day that we're selling off over here, you should technically see what? 95 stocks down, full-blown correlation. And that's something that we just haven't seen normally in markets in a very, very substantial period of time. So again, be very careful of this idea of capital rotation versus full-blown correlation. And full-blown correlation means sell side is coming. The other thing that really concerns me at this point is the volatility inside of the SPX. It's not that big this next week. This next week, we're looking at a move, okay, that's plus or minus about $26. All right. So we're actually starting the week, you know, right here at 24.31. It's plus 26 or minus 26 is ultimately what we're looking at for an expected move. The SPX expected move is critical. Now the Qs, you know, the Qs, the volatility is obviously jacked up in there. It's almost a $4 expected move. And those are the ones we've been tracking kind of day in and day out. What else do you want to throw in the mix? So let's go back to the SPX for just a moment. Do not forget, we have some big news coming out this week, okay? Big news coming out this week, like the Fed, all right? The chance of an interest rate hike are almost assured out there. But to remind you, we see the Nasdaq, okay? And the Nasdaq trades down at a point 200 points. The Nasdaq futures trade down 200 points. And I'll just let this kind of resonate with you. We're sitting on a 10% implied volatility. The VIX shrugged its shoulders, okay? If there's a trade you want to look at, okay, buy volatility. Buy volatility, not in the Nasdaq, buy volatility in the S&Ps. Because at this point in time, wow, if markets are really going to rip apart, I think you're actually going to see that the volatility proliferates, the sell side activity proliferates. Now, I don't know if it's coming this week, okay? It could take a couple of weeks to actually, you know, break through in terms of volatility over there, but be on guard as a trader. This is stuff that you have to be concerned of. Now, for some exciting news and upcoming events, let's get to it. TheoTrade.com/open. Many of you, you know, you tune into us maybe once a week over here or a few times a week to watch these TheoTrade updates. Well, guess what? We're actually going to have an open house. It'll be this coming Tuesday, June 13th. It's throughout the course of the trading session over here. So for those of you East Coast, it's 9:20 a.m. to 4 p.m. Eastern time. Of course, that's 8:20 to 3 p.m. Central over here. And we have a huge amount in store for you. It's not just myself, Don Kaufman. It's myself, it's Tony Rago, it's Doc Severson, it's Jeff Bierman over here. Okay, all of us are going to be huge on this particular open house. We're going to talk about, you know, risk management tactics. Doc is actually going to talk about building a trading plan. Jeff's going to go into the depths of technical analysis. We call him the professor because he is a professor at Loyola there in Chicago. Tony Rago, Nasdaq futures. Do not miss this event. It is very, very rare here at TheoTrade that we do an open house. The last time we had one was all the way back. The election before that was Brexit. Well, we don't want to wait anymore. We see some volatility hitting the markets over here. Join us this coming Tuesday throughout the course of the trading session. It's TheoTrade.com/open. Have a wonderful weekend, everybody. Bye-bye.